Welcome to the ncofcu.org podcast. This is Emma and Eric, and today we are going to guide you through blockchains. Picture this. It's late at night when most of the financial world is basically closed for business. But somewhere, a first responder is coming off an overtime shift, or a department is trying to move funds for disaster response, or a family is waiting on relief money, and the clock doesn't care that it's after hours.
That's the part that always gets me. Emergencies don't follow banking hours. And yet a lot of money still moves like it's stuck in a world of cut-off times, batch files, and we'll see it tomorrow.
Exactly. And that's why today we're talking about something that's quietly changing underneath the whole industry: blockchain. Not as a buzzword, not as a science project, but as real infrastructure that could actually matter for credit unions serving first responders.
Because for years, blockchain in finance felt like it lived in a lab. A proof of concept here, a pilot there, an innovation team showing a demo that never really touches everyday operations.
But that era is fading fast. What we're seeing now is blockchain moving from experiments to scale. And the important point isn't that the technology is new. It's that the use case has changed. Institutions are starting to run real activity on new rails, using tokenized money, programmable assets, and settlement that doesn't sleep.
So the big claim is, blockchain is becoming less of a cool idea and more like plumbing. The stuff you don't talk about until it breaks, or until it suddenly works better than what you had.
Right. And in financial services, the plumbing has some well-known problems. Settlement can be slow. Liquidity gets stuck in transit. Reconciliation eats time and payroll. And there are still hard operating limits because so much depends on business hours and multi-day clearing cycles.
So when we say blockchain as infrastructure, we're talking about systems designed to shrink those delays. Faster settlement. Less trapped money. Fewer manual steps. Around-the-clock capability.
Now here's where it gets interesting for credit unions serving first responders. These credit unions often make decisions through a very practical filter. Does this help members? Does it make service more reliable, more resilient, more trustworthy?
And if the answer is yes, they can move. Sometimes faster than giant banks that have more layers of approvals and more legacy systems to tiptoe around.
Let's talk about the first big piece of this shift: tokenized money. You'll hear phrases like tokenized deposits or regulated settlement instruments. But let's translate that into everyday language.
Translation: money that can move more like information. Faster, in real time, and available 24/7.
And for first responders, speed isn't a nice to have. It's the whole point. Overtime pay, benefit distributions, emergency relief, disaster response funding. These don't always line up with the Monday through Friday processing schedule.
So tokenized money can mean a credit union can help members access funds when the moment demands it, not when the system gets around to it. No waiting for the next batch window. No crossing your fingers that it clears tomorrow.
And I want to underline this. That's not innovation for innovation's sake. That's infrastructure that matches the mission. If your members run toward emergencies, your financial tools should be built for emergencies too.
Okay, now the second piece, programmable assets. This one can sound futuristic, but it's actually pretty straightforward.
Programmable assets are basically financial instruments where rules can travel with the asset itself. Ownership rules, compliance requirements, conditions for transfer. Instead of keeping all the logic in separate systems and manual checklists, some of it can be embedded into how transactions work.
Which is a big deal for operations. Because so much back-office work is really just humans and systems double-checking things. Confirming, reconciling, documenting, re-verifying. It adds friction everywhere.
And credit unions, especially small and mid-sized institutions, feel that friction intensely. They don't have endless staff to throw at manual reconciliation and repetitive workflows. So if programmable assets can reduce back-office complexity, automate certain compliance checks, and make collateral or liquidity management more efficient, that's not just cheaper. That's better service.
It's like clearing brush off the road. Members might not see it directly, but they feel the difference: fewer delays, fewer errors, faster answers, smoother experiences.
Now for the third piece, and maybe the most emotionally relevant for this audience: always-on settlement.
Because the old model is still built around limited operating windows. Even when your app looks modern, the underlying rails can still be running on. We'll process that in the next cycle.
Always-on settlement flips that. The rails stay live. Liquidity can move when it needs to move.
And for first responder credit unions, resilience isn't a slogan. Disasters don't pause for weekends. Emergencies don't wait until the next business day. System stress events don't politely schedule themselves.
So the argument is, faster settlement isn't just an efficiency gain, it can be a safety gain. If funds can settle immediately and reliably, you reduce uncertainty exactly when uncertainty is already high.
Now, some listeners might be thinking, sure, but won't the biggest banks adopt this first?
It's a fair question. Big institutions have massive budgets and huge teams, but they also have heavy baggage, legacy tech stacks, complicated approval chains, and risk posture shaped by scale. Changing core infrastructure at a giant bank can be like rebuilding an airplane mid-flight.
Credit unions can have a different advantage. They're closer to member needs. Governance can be leaner. And the mission alignment tends to be clearer between leadership, staff, and the community they serve.
Plus, adopting blockchain at scale doesn't necessarily mean ripping out everything and starting over. It can be selective. Upgrade the rails where it matters most. Pick the use cases with the clearest member impact. Move responsibly, but move.
And that brings us to the real turning point here. The question in 2026 isn't, does blockchain work? The conversation has matured.
Now it's, where does it create meaningful value? Where does it improve reliability? Where does it reduce friction? Where does it help members access money faster? Especially when life isn't calm and predictable.
For first responder credit unions, the path might actually be clearer than it is for other institutions. If speed, trust, and resilience are already core to the mission, then better rails aren't a gamble. They're a continuation of service.
And maybe that's the best way to end this. Adopting stronger infrastructure isn't about chasing trends. It's about leadership. When your members depend on certainty in uncertain moments, building systems that can deliver that certainty is part of the job.
So the next time someone says, blockchain, maybe the image shouldn't be hype or headlines. Maybe it should be that late-night moment we started with, when money needs to move, and someone's counting on it happening right now.
That's the episode. And if you're part of a credit union serving first responders, the big takeaway is simple. Keep asking the practical question. Does this make life better for members when it matters most? If yes, the future might arrive faster than people think. We want to thank you for listening to our NCOFCU podcast. And if you found this beneficial, please subscribe and forward to someone who might find it helpful also. Until the next time, be safe and continue moving forward.